Support and resistance levels are among the most popular technical indicators to find the perfect time to enter and exit a trade and are probably one of the easiest to get the hang of. Support is like those areas on the chart where there's a ton of buying activity. That means the bulls are more likely to buy, while sellers aren't so keen on selling, so the price sort of stops dropping. On the other hand, resistance happens when there's a ton of selling going on, which basically means there's a ton of supply. But the problem is, there's not a lot of demand, so the price just stops going up. Basically, what happens is that traders and investors look at how things went before and then react to what's happening now to try and guess what's going to happen next in the market. It's all about market psychology, you know? There's nothing super special about these price levels. It's just that a bunch of people in the market have access to the same info, and they're all making trades at around the same levels. All right, so there are a couple of ways to spot support and resistance levels in the market. The first and most commonly used one is trend line. A trend line is a line that shows whether the price of financial assets is generally increasing or decreasing, and these trends can change over time. When you're drawing trend lines, just make sure to pick out at least 2 or 3 of the important price points over a certain period of time. Resistance levels occur when the price slows down and moves towards the trend line. If the price is going against the main trend, that means it's having a reaction. There are lots of reasons why this might happen, like when people want to take their profits, or they're unsure about something in the short term. Traders watch the price as it gets closer to the trend line support, as this area has kept the asset's price from dropping too much in the past. Round numbers, such as $50 or $100 per share, can also act as strong support and resistance levels, because many people think in terms of round numbers and set target prices, or stop orders at these levels. This creates a large number of orders at the same level, making it difficult for the asset's price to move beyond these levels. Moving average indicators can also help identify support and resistance levels in trading. Shorter moving averages, 10, 20, 50, are good for quick profits, while longer moving averages are better for long-term investors. Traders can use moving averages to predict upward trends when price lines cross above important moving averages. If the price drops below a moving average, it's a good idea to exit any long trades they might have. So, there are other fancy pants tools to identify support and resistance levels like the Fibonacci retracement tool, which we'll go over in another episode. Keep in mind that the support and resistance zones you spot on longer time frame charts, like the weekly or monthly ones, usually carry more weight than those you see on shorter time frame charts, like the 1-minute or 5-minute ones.